Welcome back to the channel. My name is Joseph Gutierrez, and this is covering compounding. In today's video, we're going to take a look at how we can protect and grow our wealth with fixed indexed annuities. Specifically, these are FIAs designed for accumulation. We're going to take a look at how FIAs performed in the past, how they perform today, the differences between the two, and how we can use these instruments to grow our wealth safely and securely without having it exposed to market risk. So let's take a look. All right, let's go ahead and jump on in and see how these fixed index annuities can help us in retirement. Okay, we want to protect and grow our wealth without having that market risk. And that's generally how FIAs really benefit us the best. Now, remember, we're talking about FIAs for accumulation, not necessarily for the guaranteed income. Those are a different style of fixed index annuity. Today, we're focusing on the top level of our retirement ready model. The A stands for accumulation. That's safe accumulation, okay? So first things first here, we're talking about these fixed index annuities. It's a good idea just to go over how they work, how they worked in the past, how they work today, what's changed, and what we can expect or what we see in today's numbers as far as the gain, the growth, the interest crediting that we can get from these fixed index annuities. And then we're going to go ahead and take a look at an illustration with some actual numbers, okay? So first things first, we're talking about protecting and growing with FIAs. So what's the first item that people really like with fixed index annuities? Well, it's the downside risk mitigation. Okay, we don't have any downside risk in the market. Remember, we're not directly invested in the market with fixed index annuities. We utilize derivatives to mimic and model back to us interest crediting. We're going to go over how that works, okay? So with the downside risk mitigation, remember, if the market goes down, it could go down 50%, 90%, whatever. We don't see a loss in our account value. Very important. When we talk about that, we're referencing the 0 year. So we have either a positive year if the market is doing well, if our index strategy is doing well, or if it does poorly, the worst we can have is a 0 year from the price action of the underlying index, okay? So we kind of maintain our account value. Very important. One of the reasons people really like these FIAs. The other major reason is that it's a tax-deferred vehicle. Okay, and what's great about this is has to do with the rebalancing aspect. Okay, so if you ever work with a financial advisor, at some point in time, whether on an annual scale or every few years, there's some kind of rebalancing that's going on where we're trading from one ETF or mutual fund or stock to another, sell that, buy something else. Whenever you rebalance, if it's in a non-qualified account, you're going to have a taxable event. When we're inside a fixed index annuity and we're tied to, say, the S&P 500 and we want to jump over to maybe allocate a portion to a custom index that appears to be doing well, we want to add that to our total allocation, we don't necessarily have a taxable event inside the annuity. It's only when we take distributions. So with rebalancing, we don't have that tax that comes in, which is very good, very important. All right. So the question that we do get on fixed index annuities, a lot of people ask is, well, how much can I get from this? What kind of return can I get? Now, before we get into that, we need to remember that FIAs are not investments. Okay, so this may be a little bit hard for people to understand, but remember, the insurance carrier is crediting us interest based on the price action of an underlying index subject to caps, participations, and spreads and things like that. We're going to get into how that works in just a second, but just remember, if you hear us say the words return, things like that, we're talking about FIAs, we're talking about annuity insurance-based products, we're not directly invested in the market. We're tied to it via derivatives that protect us from downside risk. Okay, very important to make that distinction. Okay, so when we look back in time, we've noticed that FIAs historically did roughly in a certain range as far as return goes, and compare that to now, and it's different. We see a difference. So traditionally, we saw somewhere on the order of about 3 to 5% average annual crediting. Okay, interest crediting in the 3 to 5% range. During that time, interest rates were low, bond yields were low, and we saw kind of like a smaller interest crediting aspect there. And a lot of times people would say to the effect that is a good bond alternative. Okay, it's a good bond alternative. So when people in the kind of 60-40 blend, 70-30, what have you, the bond allocation portion, sometimes different financial advisors and annuity experts will say, well, that bond allocation would be better served in an FIA because we are performing better. We modeled it out over the last 20 years. The fixed index annuities did better than the bonds, so it made sense to change the allocation to bonds. And they still do, okay? Now, contrast that with today. We've noticed that today, we're seeing somewhere on the order of 6 to 8% plus average annual crediting. Okay, so our average annual index crediting is about 6 to 8% plus, much stronger. Okay, and a lot of times what I like to say is this is a reasonably good 60-40 alternative. Okay, I know some financial advisors may not like me saying that, but the data is kind of pointing to this. Now, it is fair to say that they're very different strategies, right? On one end, you're tied to securities. If you're working with a financial advisor, you're tied to securities. They charge a fee, 1%, 1.5%, somewhere in that range, paying them, paying the RIA, and you're invested in the market, in bonds, stocks, things like that. In FIAs, you're inside of the FIA contract. We don't necessarily have any fees unless we add riders, okay? But remember, with working with a financial advisor, you're a little more liquid, right? You can get out, you can fire your financial advisor and pull your money out. With an FIA, it's relatively illiquid because there's a surrender schedule, usually between 5 to 10 years, and market value adjustments, things like that. So it makes your money a little bit illiquid, although we do get a free 10% withdrawal rate. It's just important to know that we're kind of trading off not having to pay a fee every year with the FIA, but we're a little bit less liquid, okay? But if we have a reasonably long horizon, the FIA can work pretty well. And if we're getting similar crediting, similar growth inside of either strategy, an FIA can be an alternative, okay? Obviously, I'm not saying you should do one or the other. We're just looking at FIAs today and how they're doing and if it's worth looking into further for your own portfolio, okay? For your own retirement income plans. Now, the big question here is, well, what's changed? Why did we have 3 to 5% years ago and now we have 6 to 8%? What's changed significantly? Well, the demarcation line is this basically anything pre-2022 versus post-2022. So what happened in 2022? Okay, if you're in the CNBC stock market world, that was kind of the bond apocalypse, right? Where bond yields spiked, inflation spiked, the whole Jerome Powell and the transitory inflation. During that time period, we saw yield spike and they stayed elevated and they're elevated today. Remember back then, Fed funds, SOFR rate, the secured overnight financing rate was near zero, almost zero. It was ridiculously low, paradoxically low, insultingly low. Pick your adverb. It made no sense. We had very, very low interest rates back then. Today, we're seeing the Fed funds like 3.5%. 10 years about 4.7% and climbing, having a hard time keeping the lid on the 10-year, but we're seeing kind of more higher yields. Okay, so why does the yield affect FIAs is a good question. It leads us to how FIAs work in the first place. Remember, when you give your money to the annuity provider, they're going to take that premium, they're going to put it in their general account. The general account is going to spit out a yield based on fixed income instruments like treasury bonds, like corporate credit, things like that. It's inside a portfolio that produces yield. Most of that yield is going to be siphoned off and used as quote unquote the option budget. That option budget is tied to call options against an underlying index, a strategy, whether it's the S&P 500 or some kind of custom strategy, excess return, volatility controlled index. Either way you slice it, whatever index strategy you are tied to, you're going to be buying, the insurance company is going to be buying call options against that index, and it's going to compare the start value versus the end value for that segment, whether it's a 1-year segment, 2-year, what have you. Let's say it's a 1-year segment. Let's say, for instance, we are tied to the S&P 500, the price return S&P 500, and it gives us a 10% gain. We grew 10% in that 1-year segment. Now, the return that we get, the interest crediting that we get, is going to be based on that growth, subject to caps and participation rates. With caps and participation rates, it's best to just go by example here. So let's say the S&P 500 did 10% for the year, but our participation rate is 60%. Well, congratulations, you made 6%. So 6% interest crediting is going to be credited to you because 60% of a 10% gain is 6%. Conversely, if your participation rate is, say, 200%, well, congratulations, you just made 20% interest crediting for that year. Okay, the 10% gain times 200% participation rate. Now, let's say instead of these different participation rates, let's say you have a cap. Let's say you have a cap of 8%. Okay, put it into the calculation here. With an 8% cap, we hit our ceiling. So congratulations, you made 8%. Even though the index did 10%, you made 8% because you hit that upper cap. Okay, and then we're going to be credited interest at the end of that segment period of 8%, and our account value will grow by 8%. Okay, so that's kind of the idea how this works. Now, if you look at the overall structure, how this works, we'll notice one thing. What is the linchpin that controls everything? Well, it happens to be the option budget. It happens to be the yield that's produced off of the general account. If that yield is too low, the option budget is too low, which means that the insurance carrier can't buy as strong and as many call options, and they have to lower their participation rates, lower their caps, have bigger spreads, things like that. So, all that said, it probably makes sense why we had a lower return. If our 10-year US 10-year yield was 1%, like it was in 2021, well, we can't expect that high of an option budget, right? So we draw the connection here. Low interest rates equal low option budget. Okay, and what did that translate to? Well, if we're talking about the benchmarks, which is what we're going to look at today, we're not really going to look at the excess return, volatility control. We'll save that for another video. But for today, if we're looking at, like, let's say the S&P 500, okay, this is the price return index. If we're looking at that, we saw back then, we saw basically par rates or participation rates, basically 35 to 45%. And we saw caps somewhere around roughly like 6%. So 6% cap. So it would make sense that our average crediting was 3 to 5%. We didn't have much option budget to go around. Now, we did have other indexes that performed well. It's just that when we look at the benchmark indexes, we were kind of stuck in this 3 to 5% range for a long while. Okay. Now, today, we contrast that. We look, we have high interest rates, which means a high option budget. Okay, so with that higher option budget, remember a lot of people probably very annoyed with mortgage rates and high interest rates, and companies have high interest rates to borrow from. Well, for annuity recipients, annuity holders, that's great for us because we have more option budget, which is going to give us stronger returns, returns that rival the 60-40 split, that kind of get closer to that average return from the market with a bond portfolio, things like that. Okay, so what do we see today? Well, we see par rates kind of in the 55 to 65 rate range, and caps are 8% plus. So we're getting much better returns because the linchpin in all of this, our option budget and the general account, is producing better. So insurance companies can start raising their caps, raising their participation rates. Okay, some financial advisors out there like to kind of misrepresent it and say that the insurance carrier is being greedy and they're stealing participation rate from you because they want it for themselves. That's patently false. It has to do with interest rates and option budgets. Okay, so now that we have this understanding, let's go ahead and jump on over to a illustration and look at some actual numbers and how we can incorporate this into our own retirement plan. Let's take a look. All right, jumping on over to the illustration, let's look at some actual numbers and get a kind of a roadmap of what kind of return we can get. Now, of course, previous price action doesn't denote what we're going to get in the future. This is just a roadmap to see what kind of returns are possible, what kind of interest crediting we can possibly get. Okay, jumping on over to our quote tool here, we're going to be looking at Ocean View, one of our top rated carriers we like to work with. They have great participation rates and caps to the extent that we can get kind of today's higher returns, higher interest crediting. And when we jump on over here, we're going to look at our client here, 58-year-old in the state of Colorado with $300,000. And we can see here, we chose the Harbor View 10 product here with Ocean View. And what's nice about this is that we're getting very strong participation rates and caps. We can see all the different index strategy allocations we can choose from, and we can mix and match any way we want. See right here at the top here, we see the 1-year S&P 500 point to point and the participation rate associated with it. There's even a 2-year, so basically that means every 2 years is one segment length that we can choose from with a slightly higher participation rate. Remember, those longer duration strategies have a slightly lower option cost, or option budget goes a little bit further. Okay, and we go on down here, we can see some excess return, volatility control type indexes that are still based on the S&P 500, and some others down here, the Russell, NASDAQ, and some kind of global index trackers down here as well. So when we look at this, we're going to see, like we said earlier, the 6 to 8% range is what we feel is fairly conservative, fairly accurate for kind of the overall field. And we look here on the side and we compare, this is basically sorted by 10-year segments here. Basically the last 10 years, the return of the best 10 years of the last 20 years, and then the worst return is the one in red here. Somewhere on the order of about 6.5%. Which is well within the range there. That's 6 to 8%. And we can see that over the last 10 years, assuming the 65% participation rate, we'd be getting somewhere on the order about 10.5%. Okay, and we have other strategies here that we could also look at. We notice that a lot of them are kind of in this 6 or so percent range. We can see some of the specialized volatility excess return type indexes comfortably in the 8% range as well. So when we look at this, we can kind of open up and look at an actual illustration. Again, this is Ocean View. We're looking at the Harbor View 10. Notice right off the bat, we're tied 100% allocated to the S&P 500. We can be 100% allocated. We can be partially allocated to this or other indexes. It doesn't really matter, which just depends whatever you choose. We see here in the first ledger, the guaranteed values. It's going to show us that what happens if the index doesn't produce anything at all. And we can see that our contract value, our cash surrender value, our death benefit, how that we still have a guaranteed minimum value of the contract if the S&P 500 never made a dime between now and then. Very unlikely, but again, we show the guaranteed values nonetheless. We scroll on down the hypothetical values. They're going to look at the last 10 years and apply that against the participation rate that we have today, which is about 65%. And we can see the credited interest rate. And we can see it basically replicates itself in 10-year segments here, so and 10-year increments. So every 10 years, we're replicating this out, and we can see how our contract value is doing. If we start with 300,000 after that 10-year stint, well, assuming that the last 10 years replicates the next 10 years, which is a pretty big assumption, but just to give us a bit of a roadmap, we can see that our end contract value is doing quite well, basically in the $800,000 range from the $300,000 range. Okay, so again, it's non-guaranteed. It's just a roadmap. The end numbers are obviously going to look very different. But if the last 10 years kind of replicate for the next 10 years, we should see numbers kind of rhyme with this. Okay. So if we move on down here, we're seeing the average effective return of 10.53%, which is pretty strong, stronger than the more conservative 6 to 8% we like to talk about. But again, this is based on the S&P 500. S&P 500 is kind of the benchmark index of the market. Okay, so that particular index is a very, very strong, a strong support for how the market does as a whole. Okay, and we move on down here, we can see some of the facts about this particular annuity. This is a fixed index annuity. Minimum single premiums, $20,000. You maximum put $1 million into it. It has a death benefit. So if we were to pass away, that death benefit would be sent over to our beneficiaries, spousal continuance. So the spouse can take over the policy. And we also have these different settlement options if we want to derive income from it. You have these life only, basically straight life, life with period certain, and survivor. Okay, different items there. And then we can see down here, we can see our high period, low period, and most recent. We can notice that the high period and most recent are the same. So they're both, we're kind of in the very good accumulation block inside of the market. Okay, but remember, we're looking here at the low period. What happened during 2008, 2007? Okay, we can see that our credited interest was either zero or near zero. While everybody else was losing their shirt in the market, the fixed index annuity did pretty well. And the great thing about FIAs is that if the market drops, it usually starts to wiggle its way back up out of it. We don't experience any drop in the FIA in our account value, but we get to capture the upside. So we get to continue to grow irrespective of what happened in the previous years. Okay, so we have that 0 year as we see in 2008, near 0 year in 2007, and then we grow out of it. And then we see that when everybody else had a negative market and had a negative return on their portfolio, we saw our growth take place. Okay, so very, very good with FIAs, and why we like to utilize them as part of an additional setup for our accumulation for our retirement income plan. Okay, thanks again for watching. In today's video, we looked at how we can utilize fixed index annuities as safe accumulation, how we can grow our wealth safely inside of the fixed index annuity, protect ourselves from any market fluctuations or volatility that can sink a potential retirement. Okay, remember the last thing we just looked at was the fact that in 2007, 2008, when everyone lost their shirt, we had those nice 0% or low interest crediting years, and then we picked up where everyone left off and grew with the market while avoiding all that loss. We also looked at how the interest crediting was different back then in the 3 to 5% range and how it's doing today. Conservatively, in our opinion, in the 6 to 8% range plus. And we saw how with current participation rates, 65% on the S&P 500 with the particular carrier that we were looking at, we saw very strong gains, very strong interest crediting where we can grow our wealth safely in retirement. Thanks again for watching. Be sure to get your free ebook here on the top, we talked about accumulation today. This is the retirement ready model where we go over our philosophy on retirement income planning. Okay, very important. Get your free ebook there. If you are interested in working with us and looking at your options, how to best position yourself for retirement, feel free to click the link in the description. It will take you to our website where you can see much of our information. You can see annuity income calculators. You can see the ebook. You can see much of our information, articles, and a book now button. That book now button will bring you to our calendar where you can sign up for a free online consultation. And during that online consultation, the first one, we go over basically your situation, what you're trying to accomplish, and how these different types of products can best be placed to put you in the best position for retirement so you can have that worry-free, worry-less retirement that you deserve. Okay, thanks again for watching. Be sure to click like and subscribe. Ring the bell for future notifications on our content coming out. And I look forward to helping you become retirement ready. Until next time.